Well, good morning, everyone. I'm Bill Kennedy. I'm the CEO and Chief Investment Officer of RiskBridge Advisors. I also serve as the chairman of the Global Interdependence Center. I want to first recognize and thank Chancellor Holbrooke and the University of South Florida, Sarasota Manatee, for a very long-standing partnership with the GIC. And of course, our friends at Cumberland Advisors, David Kotok, John Mousseau, Matt McAleer, who have been decades-long supporters and contributors to GIC mission. So it's good to be with all of you today. I'm honored to moderate this distinguished panel of capital market experts who will discuss the market impact of Russia's invasion of Ukraine. We're going to go around the virtual table for about 45 minutes with a series of questions. We'll leave some time towards the end to allow those of you in the audience who are interested, if you have a question, we'll try to leave some time for that. Natalie Cohen is going to be discussing the bond market. Matt McAleer will be covering the stock market. Brandon Zick will cover every other market, specifically real assets, focusing on agriculture and the food supply. So Natalie, Matt, and Brandon, welcome. If you would, take 2 minutes, introduce yourselves and your firm, and then I would like each of you to share with the audience, both there in the Selby Auditorium and online, share with us, based on your analysis, what's one interesting thing or factoid that we may not know about this war's impact on the markets overall. So Natalie, why don't we start with you?
Okay, great. Thanks, Bill. And thank you to everyone. I'm so delighted to be here. And I do wish I was in the auditorium with everybody else, but we'll put that off to the future. So my name's Natalie Cohen. I am head and founder of National Municipal Research, which is a research and analysis company working in mostly the municipal market, but also bringing in economics around the world as they affect the bond market. I would say, let's see, maybe some in the audience know this, but between Russia and Ukraine, together they produce 70% of the world's neon, which is a critical component to the production of semiconductors. And so many of you know that there's been a semiconductor shortage, difficulty producing electric vehicles and semiconductors and microchips for all kinds of other devices, the Internet of Things, so to speak. And two of the plants actually are located in Mariupol. I don't know if I pronounced that right, Mariupol, and in Odessa. Odessa's factory actually purifies the neon for production. We have no clue what the condition of Mariupol's factory is on that. But needless to say, there's a direct impact on car production, auto production, computers, et cetera, et cetera.
Great. Thank you, Natalie. Matt McAleer, over to you.
Hi, I'm Matt McAleer, Director of Equity Strategies at Cumberland Advisors. And in terms of some effects of the Russia-Ukraine war, and they are multiple effects as we're seeing daily in the markets. But one interesting tidbit that actually I find fascinating in watching multiple markets, both equities, commodities, fixed income, both in the physical cash markets, which we're all familiar with. That's when you're buying a stock or buying commodities, and also the futures market, which is often a lead indicator of action in the cash markets, is how thin and volatile the metals markets have become over the last 6 months. So even beyond the Russia invasion of Ukraine, which often you hear the old Wall Street saw that the markets will always tell you what's going to happen. Sometimes that happens, sometimes it doesn't. In this case, the markets were getting very volatile well ahead of the invasion. Even when Russia was discounting and denying that they were planning to invade. So the palladium is Russia is the largest exporter of palladium which is used in catalytic converters, timepieces, surgical equipment. Palladium itself has had a move in a 30% band over the last 4 or 5 months. And that's an awful lot of volatility for a metal that historically doesn't trade very volatilely. So in terms of futures traders, and you may have seen the news recently with the markets with zinc and so forth, those markets have become very, very thin, very volatile, and the margin requirements and so forth have started to be ratcheted up. So I keep an eye on those markets, because when we talk about something breaking, we'll probably see it there first, and then the after effects will flow through to the equity markets.
Terrific. Thank you, Matt. Brandon, over to you.
Thanks, Bill, and I'm happy to be here. I'm Brandon Zick, the Chief Investment Officer of Ceres Partners. We're a boutique investment firm focused exclusively on investing in agriculture here in the U.S., across farmland and then other agribusinesses. I think the most unique aspect of what's going on in the markets today is that Black Sea region where the war is taking place is not only a very large provider of global grains, particularly to the Mideast, India, China, but it's also a large supplier of farm inputs that go everywhere in the world. But I think to some extent there's a little bit of confusion about when you talk about fertilizer and how much of that comes from the Ukraine. Very little of that actually makes its way to the United States. So while from an input supply issue, we think coming up on the first South American crop in September that there are going to be some dramatic effects. For the U.S., we think that'll be much more muted. And even for this crop year, we don't think that that'll be a big driver of supply shortages. But we've already pre-war been in a situation where global grain supplies have been stressed, and it's going to make its way through the system from whether it's grains into protein, dairy. So we think we're in for a pretty long ride, and the futures markets, as Matt said, are telling us that. If you look at commodity prices, there's no silver bullet, there's no quick fix. It's going to take a sustained effort to increase production because we don't think demand is going down, and we're going to need a lot of cooperation from Mother Nature to make that happen globally.
Great. Well, thank you. Thanks, all three of you. Let's get into a few questions here. So, Natalie, I'm going to start with you. You are an expert on state, local governments, municipalities, and we know that there have been some of the states here in the U.S. that were exposed to Russian assets, either through pension investments or other means. Can you provide a little bit of color as to the magnitude of Russian asset exposure at the state or local level? And have all of those governments, local governments or state governments, been required to divest of those assets?
Yes, to your last question, there are, at the state level, are the largest of the pension funds. The magnitudes vary, but they're not super significant. But the question is, if you're divesting, at what price and how much do you have to write down, and who's going to actually buy the assets? So CalPERS, for example, which is the largest, California issued, a dictum to divest, and CalPERS actually owns some illiquid assets. Between the liquid and the illiquid, it's up close to about 800 million, which is a minor portion of their overall assets. But some of the illiquid assets, for example, they have a joint ownership of a shopping mall in Moscow. So that is not going to be easy to divest. It's a joint partnership with the Hines company, Texas real estate company. And so they are questioning, they will be trying to divest, but the question is at what price and at what time will they be doing that? They're not rushing into it. And I suspect that pattern, that's certainly true in the Pennsylvania school district pension, Connecticut. There are a number of other states that have spoken about their assets. I don't think it's going to have a huge impact on the overall asset base of public pensions.
Okay, thank you for that, Natalie. Matt, a question for you. You talked about market turbulence in commodities, turbulence and volatility in the metals market and the interest rate market and the equity market. Talk about the equity market for just a second. How do you see the war in Ukraine directly affecting the equity markets, both here in the US and internationally? Is it only a potential earnings impact? Is it multiple compression, something else? How do you think about it from an equity perspective?
Yeah, specifically, the war going on currently has impact in certain areas, and Natalie mentioned neon in terms of semiconductor production. It does have that direct impact. But more broadly, what a large-scale war, and I'm not defining this as a large-scale war today, but what a large-scale war that this could become does is take the peace premium out of the market. We've traded with a peace premium now for, you could say, post-Korean War. The Vietnam War didn't have as much market impact as we might think. There was inflationary impact. But we've had a wonderful market stretch where peace was factored into pricing, was factored into risk. And if you take away a peace premium, it's very difficult to factor in that piece to pricing. We all know that markets discount, whatever market it is, let's talk about equities, discount to the worst case scenario. The market is a discounting mechanism. So right now, perhaps, worst case scenario is supply chain headaches, some food pressures, a number of one-off items. Worst case scenario on a weaponized warhead launched into Asia, into Ukraine, with perhaps some flow into Poland, a NATO country, which by Article 5 forces NATO to respond. So when I look at the equity markets and what's happening within Russia, Ukraine today, this may sound odd, but I think the pressure on the equity markets today is more trying to reprice in higher interest rates from the Fed. I know nightly we see headlines about Russia and Ukraine, and that's a human tragedy. In terms of the market, I think we're dealing more with the fear of higher rates and the Fed not being able to get in front of inflation than we are Russia and Ukraine directly. But that peace premium in the markets, and by the way, that's in all markets, not just the equity markets, that's something that has to be considered.
Thank you, Matt. Brandon, Matt just talked about food and food pricing and food insecurity. We've read that Ukraine and Russia account for a very large percentage of many important elements, whether it's materials or agricultural inputs like fertilizer. In your opinion, Brandon, what's the potential impact on future grain pricing and food pricing? Can you put some parameters around how you think that this will play out in maybe the rest of this year and then going into 2023?
Yeah, and I definitely think you have to look at it in both a short, immediate term perspective and then over the long term. From the short term perspective, what we have now are ports closed in the Ukraine, a lot of grain that was grown last year that would typically find a home in the Middle East that is unable to be shipped. So, from a supply chain standpoint, that's a short term impact. You're seeing spot prices for corn and wheat specifically, which are the two largest grain exports from the Ukraine, along with vegetable oils. Right now those prices are almost 100% higher than where they were a year ago. If you look out in the futures market 2 to 3 years, you see that it's about 30% lower than that. So while the futures market is still anticipating higher commodity prices and grain prices specifically than where we were a few years ago, they think there'll be some over the intermediate term increase in supply. To Matt's point, that market is not pricing in a black swan event. So to the extent that where we sit today, we have grain that's not being shipped, we have fertilizer that might not make its way to South America for the crop season that starts in September, which that will exacerbate the pressure on short-term supply. There's nothing that over the longer term that's being priced in. That black swan event, in our opinion, would be some type of chemical weapon, nuclear weapon that would potentially impact soil quality, water quality in that Black Sea region, and Russia potentially using famine as a form of foreign policy. That's the weapon that we would view as we would then need to rethink how everything works. In the U.S., we're really blessed from the fact that we're an exporting nation. We supply domestically most of our fertilizers. The potash that we do import, which a lot of it globally comes from the Ukraine and the Black Sea region, for the U.S. comes from Canada. So we think that we're going to have access to that. We could decide domestically, do we want to continue to export major foodstuffs? I think Europe is really questioning going forward, should they continue to do that now versus how much domestic supply do they need to build. Across the world, there only exists about 20 to 25% of global grain supply sitting in storage. So that's just over 2 to 3 months. So I think at that point, you really need to think longer term. How do you meet the demand that's out there globally? And the U.S. is well positioned, but it's going to come at a higher price. I don't think availability will be the issue. I think price will be the issue. And food and fuel for most Americans are going to be the two components of inflation that they feel the most acutely.
Understood. Thank you. Thank you, Brandon. I'd like to all three of you to opine on the question of higher energy prices. We've seen crude oil hovering around $100 a barrel. It's been higher, it's been a little bit lower, but around the $100 per barrel mark. Natural gas prices are going up. So for all three of you, could you just speak to, Natalie, we'll start with you. What's the impact of higher energy pricing for states and municipalities, and as you think about the municipal bond market?
Right. Well, the joys of the municipal bond market is its diversity and nuance. So you have states that are oil and gas producing states, and their revenues are up already. We're seeing it. So obviously Texas comes to mind, Wyoming, New Mexico, Alaska, a bunch of other states, North Dakota, and so on, that are seeing that. And as I'm sure Brandon can speak to, the grain producing states that are exporting are also seeing higher revenues. So all of that comes down into the state coffers and filters down to the local level, depending upon what's there. So Texas has always been a somewhat of a counterpoint. So as the prices go up, they do great. Everyone else is suffering and putting, higher price gasoline into their cars and so on. So that's affecting stay at home folks, they're going to continue. More people will say, I'm not going to drive every single day to work. I'm going to stay home, save a little bit of money on my gasoline, on the inputs.
Okay. Matt, how about for the public markets, either equity or commodities or even FX?
Well, Natalie makes some great points about trying to focus on where you can find benefits to some of these higher energy inputs we're seeing, whether it's gas or oil. There's another old Wall Street saw that does have, I think, some reality to it, is the cure for higher commodity prices are higher commodity prices, because those higher commodity prices drive supply from the producers. And with Brandon here on my right, he probably knows that line more than anything. If there's a crop that is staying at a high level and projected to stay at a high level, farmers will switch their fields or attempt to switch their fields to take advantage of that. As much as the drillers in Texas have been saying that the federal government is somewhat restricting their drilling, you always have to differentiate between what someone is saying and what they are doing. The Baker Hughes drilling numbers, which are released weekly, have gone up every week since January. So their board of directors and shareholders of these companies are not going to allow a barrel of oil, which hit 135 intraday a month ago, to be at that price and not have these companies drilling. So their biggest problem right now is what many of the industries are facing, and that's labor and parts, maintenance. So that's more what's holding up the drilling. That drilling is coming online. I can see it weekly in the numbers. So those higher prices will bring out more production. Again, what would really cause a long-term disturbance, and if we look at the futures charts in oil, 2 years out, and without getting into real specifics, 2 years out, oil, West Texas is being priced at about $70 a barrel versus the 100 today. So what we're talking about is being worked on and traded on and invested on daily. In terms of where we're trying to take a position, where we're positioning some capital, is in some areas that can benefit from a prolonged bid to commodities. And our largest single country allocation in our international strategy is Canada. So we feel that we need to start pointing capital to areas that can benefit economically, from this. Again, I can go on forever, so I'll add one other thing and then pass it over to Brandon. But just yesterday, we added on the pullback to our metals and mining position in our domestic strategy. That's a basket and ETF. It's XME, just to give you some information. Had a heck of a run this year for us. It's pulled back with the rest of the market. We added to it. That's in specific metals and mining companies, and some internationally, primarily domestic. So I think we have to try to focus on some areas that will see profit margins stable to rising and have the wind at their sails, and instead of trying to sail through the wind.
And Brandon, how about for agriculture? How big is energy as a percentage of cost for a farmer, for agricultural companies?
Well, energy costs make their way into the farm input sector in a number of ways. Certainly fuel is a large cost, but natural gas is a huge component of nitrogen fertilizer production. It's also a large component of chemical production. So there's a number of ways that this hits farmers. If you're a grain farmer, there is some benefit from higher ethanol prices because they are a bid in the market on the buy side for grains. But that old adage that Matt talked about, high prices solve high prices, we saw that in effect in 2012, which was the last time we had grain prices at these levels. That was mostly due to a sustained increase in demand and then a large drought in the United States. And what you saw were incremental or swing acres come on in other parts of the world. So in Brazil, they continue to convert over the cerrado, they cut down the rainforest. There's a lot of ways to bring acres on outside of the US. Within the US, acres go down every year. But the problem you have now is that to bring on those new acres, you need a large investment in fertility in the soil. And right now that could be cost prohibitive. So there won't be, in our opinion, a quick move to be able to bring on supply elsewhere in the world that historically that had been the case. So we're gearing up for a longer term increase in commodity prices. We think that oil and gas being high are going to be a driver of that. But primarily we're growing foodstuffs. And as the population in the world continues to grow, there still is increased demand for protein, increased demand for grains, and the only way to do that is to produce more with less, and that becomes more difficult as prices go up. So I think even within planting intentions across U.S. farmers, we're seeing a bigger shift towards soybeans because that is a lower input cost crop, requires less nitrogen, less risky. So they're pulling some chips off the table, whereas they might make more money growing corn. There's just too much risk involved in that because of higher inputs. So that's going to impact supply, I think, pretty dramatically come the fall, particularly if there's any type of weather event here in the U.S., and typically that would be a drought or something that happens in South America that prevents planting. And then you have the whole reason we're here today talking, what happens in the Black Sea region? Can they plant those acres? Can they export what they grew last year? And that's all going to impact price, not only in the short term, but into that medium term as well.
Great. So we have some questions coming in from the audience. Let me interject a couple of those into the conversation. So one question, what is your projection for the dollar if Russia succeeds in requiring rubles or gold for settlement of their hydrocarbon exports to Europe or into Asia? So what's the dollar view based on how Russia is using their energy exports as a geopolitical tool? Matt, you want to take a crack at that?
Sure, and there's many different inputs affecting the dollar. So sometimes we focus on one. The dollar has been ultra strong in the face of much analysis talking about a weakening dollar and the dollar being replaced as the global currency, the top global currency. Well, the markets disagree 100%. Difficult to think, Bill, that Russia demanding payment in rubles will have a direct effect on the dollar. The ruble market, like the Russian equity market, has been really a closed market. And you could say the ruble market is just being propped up by Russia. It would be difficult to think the rubles would make a dent in the dollar. What would make a dent in the dollar? It's difficult to say. I'd like to see the dollar weaken a little bit. We're in a scenario right now where you have some, and this is what's fascinating about the markets, you have some very odd cross currents happening. Historically, strong dollar would put pressure on commodities. Yet here we see commodities coming off a 12-month run. If we look at, say just some broad indices, commodity indices of, 60, 65%, 70% moves in 12 months, right in the face of a rising dollar. So what we try to think of when we're talking about allocating capital is, if the dollar weakens from here, do commodities get a second leg up? Because that's the traditional trade. Weak dollar, emerging markets, commodities. So it's difficult. It's the dollar's, from a technical standpoint, a little overbought right now. Would make perfect sense for it to pull back, but boy, is that trend strong. So, you know, a strong dollar can be problematic to both the equity market and the commodity market. It's kind of like the three bears. You'd like the dollar just right in the middle somewhere, but
A little less
my 2 cents.
volatility would be okay. Absolutely. Very thoughtful response. Thank you, Matt. Brandon, a question for you. How does a Kansas wheat farmer react or respond to what's happening globally with a supply shock to his or her main crop?
Well, if that Kansas wheat farmer knew back in the fall what was going to happen, they probably would have planted more wheat. But that's not how it works. So that's one of the reasons why it's difficult for a wheat supply to come on from the U.S. in response to a price movement, because typically they're planting hard winter wheat that was planted back in the fall. So what we're seeing now is most likely that Kansas wheat farmer is going to book some much higher revenue this year. It'll cost them a little bit more to fertilize and spray that crop because nitrogen is a big input there. In talking to our farmers that we work with across the Midwest, in many cases they use wheat as a cover crop, and many of them are looking to determine, is that a viable crop that they could then harvest instead of just use as a cover to try to be in that market. But like I had said earlier, there's no quick fix. I think longer term, if you look at the grain complex in the U.S., corn is typically the highest revenue, most profitable, then soybeans, and then wheat. And wheat is really used in areas that have better soils and better water. So the farther east you move across the Mississippi, wheat is really not a very prevalent crop because it has not been that profitable. That may change somewhat, and you'll see that become more evident in a crop rotation or crop mix. But U.S. farmers are usually very good, especially on the row crop side, of identifying how they can be profitable by rotating crops. That helps to not only decrease the necessary fertility investment in the soil, it decreases what they have to use in terms of chemicals or spray to control weeds and pests. So I think farmers tend to not move too quickly. When you see big shifts in acreage intentions, we're talking about 3 to 5%. You're not going to see the ability of farmers to move to 50% more wheat acres or 20% more corn acres. That just doesn't happen. And I think most farmers are pretty thoughtful about, over the long term, how do they manage through these markets to help maximize revenue in some years while reducing input costs in the following years.
Understood. Thank you, Brandon. Natalie, we've got a couple of questions for you. If you could address what you're seeing from a credit worthiness standpoint, and this could be property, commercial property prices, residential property prices around the country. We are starting to see mortgage rates, to Matt's earlier comment about the Fed and the Fed policy change being so prevalent, mortgage rates are now rising. How does all of this second order and third order effect come into play from your perspective?
Right. There's a number of second order things that are coming into play. I'll just mention one other one real quick. The core credit revenues in the municipal market are sales tax, property tax, and income tax. We all know about that. No one expected sales taxes to boom as we did the work from home and the lockdowns the way that they did. And that was to the benefit of state and local governments, because most of the states, especially in the South, used sales tax as a significant revenue source. Property people were moving from high density cities into less dense because of COVID. And so property values, given shortages in new home construction, secondary purchases, and so on, that has boosted property values tremendously. We've seen, I would say, given the future, higher mortgage rates and slowdown in the economy overall is going to put a bit of a damper on that. But right now, the revenues coming in on property taxes are pretty strong for state and, more to the point, local governments. I wouldn't be surprised in the near future if we start seeing some tax limitation measures coming up at the voting booth. It mimics what happened in the 70s. In the late 70s, we had Prop 13. We had a lot of other states enacting tax limitations and so on. I would not be surprised as we move into the next presidential election. Those are typically the years when ballot measures show up. And then finally, I do want to mention climate. And I know some people in the audience are keen on that whole topic. Until we hit 2020, we were on a trajectory to reduce carbon emissions, to reduce oil and gas purchases and so on, and produce more electric vehicles, put in the charging stations and all that. I would say that that's a casualty of the Ukraine war to some extent, and the shift over to oil and gas production, opening up the reserves, opening up federal leasing of mineral rights and so on and so forth. So there is a real counterpoint that's going on. Hopefully, the forecasters, some of whom are in your audience, say that we're going to have an above average storm season in the Atlantic Basin. Hopefully the Midwest farming community is not whacked this spring with heavy storms. But those are factors that are, again, maybe third degree up, a couple of levels. People are not laser focused on that and have kind of shifted their viewpoint to how are we going to reduce the cost of gasoline, oil and gas production, and so on.
Terrific. Thank you for that, Natalie. We have a question. Let me read it, and then I'll pick on a victim here. What mechanisms exist for leading the Middle East to pump more oil? And I would add to that, or is it more likely the U.S. may begin to pump more oil and gas? And Matt, maybe you are my victim. If you can maybe just talk about the supply shutdown in the U.S., a lot of that gets blamed on ESG. But we know coming out of the pandemic, many of the oil and gas companies, the production companies, had to repair their balance sheet. They had to go through a multi-quarter period of strengthening their balance sheet after a horrible period. Maybe you want to take a crack at that. First, where's the most likely spot on Earth where more oil could be pumped? And how do you think that might impact the credit and the equities for the major oil producers?
First, Bill, I think the Middle East is probably pumping all they can right now. I think there may be a thought out there that the Middle East is holding back to perhaps lean on the U.S. or damage the U.S. The Middle East they've been trying to pump. One of the things that is another peace premium tended to be, what could we do to focus on the environment? And as Natalie mentioned, war supersedes ESG. And that's just human nature. War is survival. War is short-term survival. ESG is long term. So, of course, the short term focus is what gets focused on. Bill, you're exactly right. When oil briefly went to negative, what were 2 years ago now, right? 2 years ago. Yeah, you had exploration and drilling companies, many bankrupted, many forced to raise capital at, keep in mind, with oil, even when it came back to positive, it sat at 10 and 15 and 20 and $25 for quite a while. These companies are triple B minus credits, double C credits. They're having to raise money at 8, 10, and 12%. That is expensive debt on their balance sheets. They did have pressure from the government on running their business. To what extent, we can all argue about that, but there was pressure. So we really got behind the 8 ball in terms of energy production. When you go to a point 4 and 5 years ago, now I'm not talking about ESG and so forth, but when you go to a point where you were able to supply domestically all the energy you need, to a scenario over the last 12 months where we have to all of a sudden ramp up just to bring supply on. The planning probably wasn't there. It probably had to be a dual input plan from Washington and the exploration and drillers, and it got a little bit too confrontational. Now, hopefully that's behind us. And by the way, you can still bring on supply with an eye on the climate. They're not mutually exclusive. Sometimes the loudest voices on both sides get all the attention. And that's in politics, that's in anything politics touches. The reality is, producing oil and gas in the U.S. today, and this is just a recent white paper I read, is almost 10 times more efficient in terms of dirtiness to the climate as it was just 20 years ago. That is, oil and gas companies today in the U.S. are technology companies. Oil is just a product. And the technology that has been increased and used in Texas and in Pennsylvania, it's fascinating. And sometimes there just needs to be dialogue to take advantage of this technology and not try to frame either or as the bad guy. So.
Yeah, I completely agree. That strong hand that I mentioned that we have in agriculture, because we're an exporting country, we export 40% of what we grow. We certainly have that capability on the energy side, and it's a little frustrating for someone who's pretty pragmatic to see us waste that opportunity. I think, to Matt's point, what happens in the U.S. is as clean as anywhere in the world, if not cleaner. So if we're going to do something, I think in terms of oil and gas exploration, I think from the ESG standpoint, it should be encouraging that here domestically with better regulation, better monitoring than what happens in Russia or other parts of the Middle East. So I hope there's a policy change over time. We'll see if that happens. But you're right, the war will exacerbate and really force that discussion to happen.
Sure.
So, Brandon, this is a topic and presentation on Ukraine and Russia's invasion. We haven't talked about China and China's reaction. China's watching carefully how the Europe and NATO and the U.S. are responding. Can you help us understand from an agricultural and food import perspective, where is China? Has anything changed? And how's that impacting the investments that your firm is looking at?
Yeah, I wish Leland was still on to talk about this too, but I think China is right in the bullseye right now. They are a huge importer of global grains. For every uh, soybean that's grown in the world, 2/3 of that bean ends up in China, primarily as livestock feed. Historically, China's always been a domestic producer of corn. Last year, they became a huge importer of corn because of a crop failure they had. They are not self-sufficient. Their soil contamination, water contamination, the inability to grow a crop to feed their population puts them, I think, in dire straits. There's a reason why they've had these investments in all other parts of the world in infrastructure to try to be able to buy grain, buy food stocks to bring in, and primarily in places like Brazil, that's their largest trading partner for ag. I think right now, uh, Brazil is also in a little bit of a tough spot because they're going to have a hard time sourcing some of the fertilizer they need for their crop later this year. For the 2022 crop in the US, all of the fertilizer we need is at local levels, local distribution. And while that price for next year may be higher, we think there will definitely be availability. In other parts of the world or the globe that supply China, they are going to have a much harder time sourcing those inputs, which ultimately means China will have a harder time sourcing the grain that they need. And when you have totalitarian governments, the one thing they cannot afford is a hungry populace. So I think every effort will be made to try to source that going forward, but there is no 2 or 3 year pile of grain stock sitting somewhere in the world. It's 2 to 3 months. So if there's any supply disruption, whether it relates to the war or simply Mother Nature, we're going to see a pretty quick whipsaw on not only commodity prices, but the availability of those commodities for all of those food importing nations. So I think that's what I would keep my eye on more from just the global dynamic. Where is there just no availability regardless of price?
Thank you, Brandon. So we're coming up to the top of the hour, a few minutes left. Let's, Kelly, if you're in the audience, I want to see if there's anybody in the audience that would like to ask a question. I think we have a mic available.
Hello, Bill. This is Bob Bunting, the CEO of the Climate Adaptation Center. And boy, you've made some wonderful points here. I have two comments. One is informational. Ukraine and Russia produce about 14% of the world's wheat, so it's not inconsequential. However, the United States is in an epic drought situation in parts of the grain belt, including the wheat belt. Some of you probably know the western half of the quarter of the U.S. is in a 1,000-year drought that is historic by any nature, including Lake Mead being at the lowest point it's ever been in since it was constructed as far as water supply. But in the wheat belt, 36% of all the winter wheat is rated as poor or very poor right now in condition. And only 30% of the wheat is rated as good or very good. So as this harvest comes in, I really believe it's going to put more pressure on grain prices, especially wheat. And so that's a factor to think about in the inflation. And also just a quick comment about energy efficiency. We always think about drilling more oil or gas, and the U.S. is really getting much better at being efficient. We produce only 15% of the greenhouse gases in the world these days, which is a great improvement. But the other part of it is that 1/3 of the world's energy goes into heating and cooling buildings. And those buildings could be retrofitted right now with technology that exists right now, that the U.S. makes right now, and we could cut our carbon footprint and increase our exports dramatically if we decide to do it. So those are my comments.
Thank you, Bob. Thanks for joining. Thanks for your comments, and it's good to hear your voice.
Okay, we have another one from the audience.
Thank you.
The question concerns North Korea. They're already a hermit state, and they import the vast majority of their wheat and grain and everything. What do you see as the impacts on North Korea?
Well, from our standpoint, less global availability for exports means worse conditions for North Korea. And I think across the board, any of these grain importing states that have little to no currency value makes it very difficult it's going to be very difficult for them, as there are supply shortages, to be able to access that. We even see in the US there could be a push for fewer grain exports into the global market to help secure domestic supply. I certainly think that will start happening in Europe at some point, because of what will happen there in terms of whether it's natural gas or fuel shortages, that there's going to be a push to do that. So I think across that just global grain importing market, you're going to see higher prices, less availability, and more scrambling.
Other questions?
Bill, it's David Kotok at USF. We have a hybrid event, and here we have an audience, and then we have a bunch of listeners. You're the chair of the Global Interdependence Center. And I might point out to those who are virtual and those who are in this room, every panelist that you saw in each of these sessions and the next session are members of the Global Interdependence Center. And the Global Interdependence Center is a neutral convener of dialogue like this worldwide. I wonder, Bill, before we close this session, if you could spend 2 or 3 minutes, now that the GIC is back in business again. I know you're going to be in Paris. We're going to be in Paris in a week and other places. Can you give us a 2-3 minute where the Global Interdependence Center is going to be in the next year before we're back in USF's auditorium for another session?
Which we can't wait. But thank you, David, for the shameless plug. And David will collect your GIC dues for anybody who would like to join this morning. So the GIC is going back to live events beginning on May 6th. We'll be in Paris for a central bank series at the Banque de France. We'll be hosting a conference here in New York City on May 19th, focusing on long COVID, with a very distinguished day, a day of very distinguished speakers, focusing on the economic impact, the policy impact, the political impact of long COVID. We'll be heading out to the Rocky Mountains, to the Jackson Hole area for the Rocky Mountain Economic Summit in July. And then going into the second half of the year, we will have an ESG conference at Rowan University. We'll be traveling to Montreal for an event, and probably a trip back to Madrid. So we're very excited to be reconnecting with our friends and our network. The GIC, as David mentioned, is fully committed to hosting events like this that are nonpartisan. We explore every side of an issue. We do so in a very neutral way, in a neutral format. And then we also have just a wonderful organization called the College of Central Bankers, which you'll be hearing from shortly. And College of Central Bankers, which is chaired by Peter Gold, has really built a tremendous platform for us to deepen our relationships with all of the monetary policy makers, not just in the Federal Reserve System here in the US, but with former monetary policy makers from around the world. And so very excited about what's happening at GIC, and we're very honored to be participating in this event today. So thank you for that, David. Before we close out, let me just, I want to do a speed round, if I could, with our terrific panelists while we have them. So very simple question. In the next 12 months, US will see a recession, yes or no? Natalie?
Sorry, I had to unmute. I think it's possible. it's hard to handicap it exactly, but the slowdown is starting to appear, and there are areas where, where it could affect certainly people, property, revenues, companies, and so on. So that's a kind of a squishy answer, but we'll see.
We'll take squishy. Matt.
By the definition of recession, I'll guess no. I think we'll see enough of a slowdown that it's noticeable, which would probably be a benefit to inflation. Remember, there's a benefit and a negative to anything that happens. David was saying earlier when we were chatting, my famous morning lines are: what can go right, what can go wrong, in every security we own, in every industry we own, in every country we own. And I think you have to look at that on almost any decision you make or want to make or have an opinion on economically. So I guess recession, a negative print, 2 quarters in a row. Recession and markets are two different things. I'll also say we don't trade recessions, we trade securities. So whether we have a recession or not, we have to be positioned in the best way to help our clients. If we have a recession and we're positioned properly and our clients do very well, then we did our job, recession or not. But I would think the fact that we are coming off such low rates that perhaps people are getting ahead of themselves, thinking a 3.5% 10-year treasury bond, we're not there today, we're at 275, is going to be enough to crack the economy. May slow it. I'm going to lean against that for now.
All right, a market is forming. We've got the bid-ask spread between Natalie and Matt. Brandon, you're the final decider.
Yeah, my guess, like everyone else, is in the next 12 months that it would be unlikely. In the next 24 months, I'd say it's more likely. It's all going to depend on the actions of the Federal Reserve, in my opinion.
Terrific. Well, ladies and gentlemen, I want to, first of all, thank you for paying attention and for joining us today. Please join me in a big round of applause for our panelists, who I think did a fantastic job. Thank you all very much.
Thank you. Thank you, Bill, and thank you to the panel.